December 2013, Tallinn, Estonia. Howard Wilkinson is sitting inside Danske Bank's Estonian branch with two versions of the same company in front of him. One exists on paper, the other exists inside the bank. They should look roughly the same. They do not. The company is called Lantana Trade. It is a British limited liability partnership. According to records filed with Companies House, the company is supposed to be dormant. According to the activity Wilkinson can see inside the bank, it is anything but dormant. Large sums are moving through its account. The public paperwork says almost nothing is happening. Both records are real. Both belong to the same company. And that contradiction is about to become much more important than anyone in the room realizes. Wilkinson sends a warning to Danske Bank's headquarters in Copenhagen. The subject is blunt. The Estonia branch may be knowingly dealing with criminals. But this story does not begin with a secret hacking tool. It does not begin with a suitcase of cash. And it does not begin with a hidden vault. It begins with two columns that refuse to match. Years later, investigators and journalists would find the same contradiction at a scale measured in billions. 9 British partnerships would appear in banking records, receiving roughly $4.1 billion. Their public financial statements reported less than $500,000 in combined revenue over the corresponding period. The difference was almost absurd. But there is an important distinction. No single spreadsheet proved that every dollar was criminal, and no suspicious activity report is a conviction. The spreadsheet was something more basic. It was the place where information from separate systems could finally meet. This is how a simple comparison exposed one of the weakest points in the global banking system. To understand why, go back to Lantana Trade. Wilkinson was not an outside investigator. He worked at Danske Bank. His team handled currency and bond trading in the Baltic region. The branch around him was unusually profitable. One division specialized in customers who did not live in Estonia. Many came from Russia, Eastern Europe, and Central Asia. For a small Baltic branch, these customers could generate enormous business, and money entering Tallinn did not have to stay in Tallinn. A customer could hold an account at a regional bank. The regional bank could then use a much larger international bank to access dollars. That larger institution is known as a correspondent bank. The arrangement is ordinary. Global finance could barely function without it. A local bank cannot maintain a physical branch in every country and every currency. So banks maintain relationships with other banks. One institution knows the customer. Another moves the dollars. Another receives the payment. Another holds the corporate registration. Another receives a suspicious activity report months later. Each system sees something. No system necessarily sees everything. That is where the weakness appears. Lantana Trade was registered in the United Kingdom. There is nothing inherently suspicious about that. British limited liability partnerships are used by legitimate businesses every day. They combine elements of a partnership with limited liability. They also create paperwork, names, addresses, financial statements, annual filings, the kind of records that make a company look measurable, and measurable things feel controllable. But paperwork is only useful when somebody checks whether it describes reality. When Wilkinson first looked at Lantana's Companies House records, he found a company that appeared dormant. The activity inside the bank told a different story. Colleagues initially treated the discrepancy as an innocent mistake, a filing error, something administrative, something small. Then Wilkinson checked again roughly a year later. The paperwork had changed. The contradiction had not. So he kept digging. He found 15 more Danske Estonia customers that had apparently submitted false financial statements. He sent more warnings. He urged headquarters to examine the British LLPs and LPs banking through the Estonian branch. By early 2014, the problem was moving upward through the institution. And now the bank had a scale problem. Closing one suspicious account is easy. Questioning an entire profitable customer portfolio is different. Every customer means transactions, fees.
In a suspicious activity report filed in 2015, Deutsche Bank said its New York branch had helped process approximately $2.6 billion in payments to Ergo Invest during the previous 3 years. Another roughly $700 million went to Chadborg Trade. Together, that is around $3.3 billion. Now open their British financial statements. For 2013, 2014, and 2015, both companies reported annual income measured in tens of thousands of dollars, not hundreds of millions. Not billions. Tens of thousands. The filings were also strikingly similar, and both carried the same unusual signature above the printed name of Ali Mulai. One database described tiny companies. Another described enormous flows. Nothing complicated had to be decrypted. The systems simply had to be placed beside each other. But the banking system had another chance to see the problem. According to ICIJ reporting on a draft internal investigation prepared for Deutsche Bank, automated anti-money laundering systems flagged Ergo Invest 12 times between July 2013 and January 2015. Compliance staff reviewed those alerts. And on those occasions, they decided against filing a suspicious activity report. The machine noticed something. Humans reviewed it. The money kept moving. Then a different pattern became impossible to ignore. Mirror trades. Between 2012 and 2014, Deutsche Bank customers in Moscow and London were executing securities transactions that closely mirrored each other. A security would be bought on one side. A corresponding transaction would occur on the other. The values and volumes matched. The customers were connected. Economic value entered in rubles and emerged elsewhere in dollars. British regulators later found more than 2,400 pairs of these mirror trades. They transferred more than $6 billion from Russia through Deutsche Bank in the United Kingdom to overseas accounts. Regulators also identified another $3.8 billion in suspicious one-sided trades. The Financial Conduct Authority said Deutsche Bank's anti-money laundering framework had serious deficiencies. Customer due diligence was inadequate. Risk rating methods were flawed. Transaction monitoring was inadequate. Oversight was weak. In January 2017, the FCA fined Deutsche Bank more than £163 million. 1 day earlier, New York regulators imposed another penalty, $425 million. New York's Department of Financial Services described a mirror trading scheme that had moved roughly $10 billion out of Russia. Now the scale was public. But notice what had happened. The scandal did not require one perfect failure. It required many ordinary failures to line up. A company registry accepted financial statements. Formation businesses created corporate structures. Local banks opened accounts. Correspondent banks moved dollars. Automated systems generated alerts. Employees reviewed them. Suspicious activity reports were filed later. Regulators received fragments. Every layer had a procedure, and the money could move while those procedures operated. This is what makes the story different from a conventional heist. There was no vault door to defeat. There was no single guard to distract. There was no alarm that needed to be disabled. The weak point existed between institutions. Each organization could perform its own narrow task without reconciling the entire picture. The company exists. The paperwork is filed. The account is open. The transfer has the required fields. The correspondent relationship remains active. The alert has been reviewed. The report has been submitted. Individually, every statement can sound reassuring. Together, they can describe a system moving billions for entities it does not fully understand. The FinCEN Files made that fragmentation visible. ICIJ found that in roughly half of the reports it analyzed, Banks lacked information about at least one entity behind the transactions. In some cases, one bank asked another for more information. Sometimes no useful answer came back. Meanwhile, a suspicious transaction does not stop existing because a bank files a report. The SAR system is designed to alert authorities. It is not automatically a red button that freezes every payment. That creates a strange contradiction. A financial institution can become suspicious enough to report a customer and still continue processing transactions involving that customer. Sometimes that is legally appropriate. Suspicion is not proof. Stopping legitimate payments without cause can also create serious problems. But at massive scale, the same caution can create space for bad actors. The system must distinguish unusual from criminal, fast enough to stop crime, carefully enough not to punish innocent customers, across millions of transactions, every day.
Criminal networks only need the gaps. The Danske Estonia case shows what happens when those gaps become structural. On September 19, 2018, Danske Bank published the findings of a major investigation into its Estonian branch. The investigation covered around 15,000 customers with non-resident characteristics. Together, they had made roughly 9.5 million payments between 2007 and 2015. The total payment flow was approximately $200 billion. That number is often described too casually. Danske Bank did not say that every euro of the $200 billion was laundered money. The bank itself warned against making that assumption. Investigators prioritized about 60 to 100 customers that triggered the most risk indicators. The vast majority of those analyzed customers were found to have suspicious characteristics. A suspicious customer still does not make every payment criminal, but the scale of the exposure was undeniable. And Howard Wilkinson's old contradiction suddenly looked different. The dormant company, the active bank account, the false-looking filings, the warnings sent to Copenhagen, the 15 additional customers he found. These were no longer isolated accounting curiosities. They were early cracks in a much larger system. The consequences kept growing. In 2022, the U.S. Department of Justice described what happened in much less ambiguous legal terms. Danske Bank pleaded guilty to conspiracy to commit bank fraud. According to the bank's admissions and court documents, its Estonian branch operated a lucrative non-resident portfolio between 2008 and 2016. High-risk customers could transfer large amounts with inadequate oversight. Shell companies were used to obscure ownership of funds, and access to American banks was critical because the customers needed U.S. dollar transactions processed through the American financial system. The Justice Department said the non-resident portfolio processed approximately $160 billion through U.S. banks. By at least February 2014, Danske Bank knew from internal audits, regulators, and a whistleblower that some customers were engaged in highly suspicious and potentially criminal transactions. The bank also knew its Estonian anti-money laundering controls were inadequate for the risks involved. Yet U.S. banks were given misleading information about those controls and the customers they were serving. Danske Bank agreed to criminal forfeiture of $2.159 billion. The Securities and Exchange Commission separately announced a settlement of roughly $413 million over allegations that the bank misled investors about its anti-money laundering failures in Estonia. Years had passed since Wilkinson compared a company filing with a bank account. Years had passed since automated systems began flagging companies like Ergo Invest. Years had passed since billions moved through shell companies whose public paperwork described businesses of almost microscopic scale. The eventual investigations were enormous. The penalties were enormous. The data sets were enormous. But the original contradiction was tiny. One company says it is dormant. Its bank account says otherwise. One company reports tens of thousands in income. Banks process billions around it. One signature appears on one filing, then another, then hundreds. The system did not lack information. It lacked connection. That is why calling this the story of a single spreadsheet is both wrong and strangely accurate. There was no magical Excel file that solved a $4 billion crime. Journalists worked through thousands of confidential reports. They extracted hundreds of thousands of transaction details. They checked public records. They interviewed people. Regulators conducted separate investigations. Banks performed internal reviews. And prosecutors later established criminal conduct in specific parts of the wider network. But after all that complexity, the most powerful operation remained almost primitive. Put column A beside column B. What did the company claim? What did the money do? The difference between those numbers did not prove every suspected crime. It did something investigators need first. It showed where the story stopped making sense. And once that happened, the system itself became evidence. The same corporate structures appeared repeatedly. The same formation networks appeared repeatedly. The same banks appeared repeatedly. The same warnings appeared repeatedly. The same problem crossed borders faster than the institutions responsible for monitoring it. Britain held the company records. Estonia held customer accounts. Germany and Britain handled major banking operations. New York cleared dollars. American authorities received suspicious activity reports. No single jurisdiction owned the entire picture. The money did not need to break the global financial system. It only needed the global financial system to remain fragmented. That is the uncomfortable part. The companies did not become powerful because their paperwork was sophisticated. Some of the paperwork was almost laughably thin. They became useful because powerful institutions treated individual pieces of paperwork as separate facts. A registration was a fact. A bank account was a fact. A wire instruction was a fact. A compliance review was a fact. A SIR was a fact. But the contradiction between those facts belonged to nobody, until somebody put them on the same screen. Howard Wilkinson did it with Lantana Trade. Journalists did it across thousands of records. Regulators eventually did it across banks. Prosecutors did it across jurisdictions. And every time the picture became wider, the amounts became larger. The $4.1 billion attached to those 9 LLPs is not proof that every dollar entering those accounts was criminal. Ali Moulay was never charged with wrongdoing and denied involvement with the companies whose filings bore his name. The roughly $200 billion examined at Danske, Estonia, was not declared entirely laundered money. Suspicious does not mean guilty. Those limits matter, because the real story does not need exaggeration. The proven failures are already large enough. A major bank admitted defrauding U.S. banks about its customers and anti-money laundering controls. Another major bank was fined hundreds of millions for controls that regulators said allowed roughly $10 billion to move out of Russia through suspicious trading. Public filings showed companies reporting tiny revenues, while bank records recorded flows measured in billions. Internal warnings existed. Automated alerts existed. Regulatory mechanisms existed. And for years, the money still moved. That is the weak point. Not the absence of rules, not the absence of databases, not the absence of compliance departments. The weak point was the space between them. A spreadsheet cannot arrest anyone. It cannot freeze an account. It cannot prove intent. It cannot tell you whether every transaction in a column is legitimate or criminal. But it can perform one brutal function. It can force two systems to answer the same question at the same time. And when one says 5 figures, while the other says 10 figures, somebody eventually has to explain the difference. The global banking system had many of those numbers already. Companies House had its numbers. The banks had theirs. Compliance teams had alerts. FinCEN had reports. The information was scattered across institutions, countries, and formats. Then the columns met, and billions appeared in the gap. The disturbing question is not why investigators eventually saw it. It is how many similar contradictions never reach the same spreadsheet. Somewhere, another ordinary filing may already be sitting beside an extraordinary flow. Two perfectly valid records, two completely different realities, waiting to be compared. The companies did not become powerful because their paperwork was sophisticated. Some of the paperwork was almost laughably thin. They became useful because powerful institutions treated individual pieces of paperwork as separate facts. A registration was a fact. A bank account was a fact. A wire instruction was a fact. A compliance review was a fact. A SIR was a fact. But the contradiction between those facts belonged to nobody, until somebody put them on the same screen. Howard Wilkinson did it with Lantana Trade. Journalists did it across thousands of records. Regulators eventually did it across banks. Prosecutors did it across jurisdictions. And every time the picture became wider, the amounts became larger. The $4.1 billion attached to those 9 LLPs is not proof that every dollar entering those accounts was criminal. Ali Moulay was never charged with wrongdoing and denied involvement with the companies whose filings bore his name. The roughly $200 billion examined at Danske, Estonia, was not declared entirely laundered money. Suspicious does not mean guilty. Those limits matter, because the real story does not need exaggeration. The proven failures are already large enough. A major bank admitted defrauding U.S. banks about its customers and anti-money laundering controls. Another major bank was fined hundreds of millions for controls that regulators said allowed roughly $10 billion to move out of Russia through suspicious trading. Public filings showed companies reporting tiny revenues, while bank records recorded flows measured in billions. Internal warnings existed, automated alerts existed, regulatory mechanisms existed, and for years, the money still moved. That is the weak point, not the absence of rules,